With electricity generation in Nigeria falling short of required generation capacity, it is disturbing that the little power generated is also being stolen by some unscrupulous consumers. According to the latest report by the Association of Nigerian Electricity Distributors, an umbrella body for 10 of the 11 discos in the country, this disclosed that electricity distribution companies lost about 97 billion naira was lost in the first quarter of the year. That's ascribed to energy theft, capping of estimated billings, and other factors. The data also shows that the amount lost by power firms due to this trend rose by 12.79% in Q1 of 2021 from 86 billion naira in Q4 2020. However, going by the poor state of the power supply across the country, industry players are of the view that this whopping amount, if significantly reduced and spent on power infrastructure and management, will help improve the power situation across the country. As the federal government makes concerted efforts towards transforming the power sector, the question now is how best can this menace be curbed drastically? To provide solutions to this and, of course, other issues affecting the power sector, I have joining me the former chairman of the Nigerian Electricity Regulatory Commission, NERC, Dr. Sam Amadi. Dr. Amadi, good afternoon, sir. Dr. Amadi, if you can hear me. Yes, good afternoon.
I hear you.
All right, let's go ahead. Good afternoon. It's good to talk to you today about this very important issue. Discos have come out to say about 97 billion has been lost in just the first quarter. And we also see losses also being recorded even on the generation side. It's still about loss, loss, and loss. So tell us, why is this still happening despite all of the efforts being put to at least rearrange or reorganize the sector?
Very much. Well, we are dealing with losses because that's where the market is right now. The real crisis is that even though government is trying to work hard to develop a network and improve supply, there's still stranded costs, stranded energy. Like Augustin said, we're not able to evacuate, we're able to sell, and therefore we're able to recover revenue and pay. So essentially, as long as the tariff does not reflect those inefficiencies, and of course they shouldn't because of the economic circumstances, the regulator would always have constrained some recovery. If you look at Europe, we've seen cases where due to increase in gas supply, gas cost, there's some energy prices are going up. And at the same time, regulators are saying you can't recover everything now. So the problem is that the under recovery keeps increasing instead of reducing. So even with some of the increases in tariff, we've seen the increase in costs arising from increasing inefficiency, increasing shortfall, both in capacity delivered and also in revenue recovered, means that some of these symbolic or band-aids in terms of tariff increases are not reflecting in reducing the debts in the sector and reducing under recovery. So primarily, as the sector gets worse in terms of collapse of infrastructure and in terms of lack of revenue to ramp up these networks and improve them, and of course the tariff cannot go up that big to cover for both rise in inflation, foreign exchange is also getting bad and bad because of course, obviously economic circumstances and the COVID situation globally. So what this means basically is that look, the utilities are spending are getting less and losing more, and therefore government's own the debt overhang increases, and tariffs cannot move so fast to cover this gap. And at the same time, efficiency gains are not happening because efficiency increase is slow, and therefore you're not scale is still low, so unit cost is still high, and then basically you are being hit at two ends. The tariffs are not, even they go up, they're not going up enough to cover the increasing losses. So that's what we're seeing, that this sector will continue to see increase in debts, we're going to see low liquidity until two things happen at the same time. We improve tariffs as we are doing gradually, but at the same time we are improving quantity, improving efficiency, and therefore losses are getting less and less. And to drive down losses, you need to make the investment. Make the investment, you either need debt or you need the revenue. And two of them are not coming up that quickly.
Dr. Amadi, let's look at capping of estimated billings. That's very important to me because we know what's happened with regards to estimate bill Nigerians. A lot of issues regarding that. The solution to this is metering, obviously. How well? Let's start with the MAP scheme, and now we have the national metering scheme instituted by the federal government. Are we really getting there, talking about bridging the gap that has to do with metering?
I think anecdotal evidence. I'm talking to industry players and also talking to consumer and one of them. In the metering rollout is not doing enough. It seems some people think perhaps it's a small screen that maybe in a cynical manner, maybe the central bank is providing funding, something to pop up. But basically, the number of meters deployed in this scheme and the fact that most discos are using them to do replacements for meters they allege are not functioning well, or meters that are probably tampered. So they are trying to contain, reduce losses in terms of metered energy that the meter is not good. So the rate of closing, we're not closing fast the gap of meter customers. And as long as NERC continues to cap that estimation, which is the right thing to do, by the way, because the losers in this market largely are meter customers who have no capacity to control their consumption and therefore mitigate the rate impact and the volumetric impact of the rate increase. So they are left with a short stick. They can't improve their situation and they are open to exploitation by the marketers. And then NERC has to step in. And stepping in therefore means that the discos will probably miss out on the dump, where they dump the cost on these meter customers and force them to pay. Now they are capped. So whatever shortfall that they get from poor metering, from other inefficiencies, one area in which they can make it up is kind of constrained. So what we are seeing that the metering plan is not aggressive enough. The meter customers are not being metered quickly, and therefore the discos technically continue to lose energy because they're not sure, they're not able to collect what they send to customers, and customers who are metered remain a problem, and therefore it constrains the rate of increase in tariffs. So if you have let's say 80% or 90% metering rate, what that means therefore is that the regulator could unlock and more faster, and with the implication that customers can mitigate their rate shock by basically conserving their energy and consuming less. But when you are unmetered, then that conservatory behavior that helps you to reduce volumetric impact of increased tariff is lost. So the lack of speed of metering, it's also contributes both to the loss of revenue for discos as well as loss of confidence in customers and therefore loss of opportunity for ramping up tariffs as quickly as operators may want.
Staying with losses now, the GenCos have also come out to say that about 34% of their capacity, their generating capacity, is stranded. Well, better than what they used to have before, 48.3% in 2020. But the issue now comes to infrastructure that can aid the movement of this power which we generate. Would you say the private investors have done well also in investing in infrastructure? Dr. Amadi, this is key. Are they also playing their role? I know government also has a role, which they also need to play. But on both sides, do you think we are doing our best? We need to leave this between 4,500 and 5,000 megawatts for 200 million people.
Well, the point is that when you sign up for a private electricity market, what you sign up is that operators will respond to price signals and respond to stability. Okay, technically, the idea is that, look, that we have a huge energy demand gap. So that means one could argue that it's important, it's clear that this is a profitable market. But the caveats are that, well, you have to have orderly market, you have to have capacity to pay, you need to have tariffs that also cover the cost. Now, for the discos and operators, the transition company and the discos, it's a function of, are they able to make those investments and defy recovery? So this is, something has to give in. You see, there must be massive investment in strengthening the infrastructure to allow for efficient evacuation of power. Those investments have to be paid for, but they may not be paid in the short to medium term. They may be long-term investments. Now, there's a mismatch between the tenure of borrowing that these operators are able to access and the duration in which recovery can happen, given the factors, the risk in this market. So what that means, therefore, is that they're not getting enough access to capital to finance recovery, sustenance, and maintenance of their network, or even expansion. And so when this goes easier to generate power, once they have the gas and the turbines are running, it's in their interest to generate at peak capacity. But the question is, you have to discharge that power, you have to transmit the power, you have to distribute to the consumers. And so the TCL and the DISCOs don't have the capacity perhaps to loop up their network in a way that this power can be dropped anywhere. They can pick the load and they can transmit and they can also distribute to their customers. So these frailties need financing. They need change management strategy. Probably, arguably, one can argue that apart from the lack of access to finance, maybe they don't have the state-of-the-art management and technical capacity to reduce these losses. Don't forget that the baseline or the benchmark for privatization is that these companies can actually quickly reduce losses. So they need the managerial capability, they need the access to capital, and they need recovery of revenue, which will help them to access capital. So basic problem is, look, you need to really bridge this gap. Where do you find the money to improve your network? And then find regulatory stability to assure the investors, whether they are foreign or local, that within 5 to 10 years, they will get back their returns with profit. But in the meantime, that the recovery will be slow because of the inherent weakness of the system. So the hot money has been what the DISCOs and TCN are probably having access to. They need to have long tenured funds. Some people think perhaps the pension fund or some other long-term funding can help. Clearly, this market may come up to become a very solvent market. But in the short to medium term, you need to abridge this shortage and you need to have some kind of financing that doesn't require quick recovery and quick return, because the pricing will scale up gradually, capacity grows, revenue improves, and then losses drops because of those investments. But we're not getting to do that kind of funding. The DISCOs don't seem to have that level of managerial and technical capability and the access to financing that we thought would be very obvious and open to them once we privatize.
Before I let you go, Dr. Amadi, what do you understand as a professional in this space as a cost-reflective tariff? That has been the argument for some time. The DISCOs will say we are not allowed to charge cost-reflective tariff. What do you understand as cost-reflective tariff?
For me, cost-reflective is like a sorcery stone. People keep taking different form, but what it means basically is a tariff that covers cost of production and return on investment, and of course provide other incentives. But then the big issue is, what is it exactly? It depends always. It's an art and a science. The methodology is clear, the method, but then the regulator will look at incidents, look at economic situation, and of course look at the level of efficiency of the DISCOs. Now let's assume that the amount of power, unit cost for power that we should have is X. But the question is, if you price it at that X and you get this recovery in 2-3 years, can you price that X minus 1 and get full recovery in 7-10 years? Now, that's how the market works. You don't have to have that price as long as the operators have assurance that all what you call the shortfall will be made good in a reasonable time. And the regulatory framework is trustworthy. That's the market will operate. So the notion that the pricing of this market should be such that in 2-3 years we get the funding back will not work. We're going to have the tariff sculptured in a way that allows for the economic situation, for example, COVID all over the world. So people are asking for increase, and the regulators are looking at what is feasible, but also providing financial instruments that encourage investors to access funds in the hope that these shortfalls will be covered in a couple of years down the line. But I think our market is perhaps chronically underfunded and underpriced. And moving the two together, considering the loss of revenue, considering the very weak, fundamentals of the economy, and especially household economy, people are not earning much, and people are being taxed at different level. It looks like really a difficult proposition to have the right kind of tariff we need at this point, with the right kind of quantity of supply, the right kind of quality of supply, all at the same time. That's what's making it difficult. So theoretically, you can say the right price is X, but in reality, that price might be a price that the regulator may not want to recover now, immediately, because it's difficult to recover, and it could even lead to serious bypass and other kinds of theft of energy when the tariff becomes unaffordable. So it's really a balance of science and art. We have to make sure the methodology is correct, but at the same time, we have to look at the situation when we decide what the price should be at a particular time.
Dr. Sam Amadi, I must thank you so much for your time joining us on the show this afternoon. Really interesting having you help us break this down. Dr. Amadi is a former chairman of NERC, Nigerian Electricity Regulatory Commission. Thank you so much and enjoy the rest of your day.
Thank you very much.